Welcome to the Motley Fool's Crunch Time series, where we scout out a single company from the story to the opportunities and risks. Let's take a look at one of the emerging brands in EV charging, EVgo. First, my prediction. I think EVgo stock could beat the market over the next 5 years, but I have some serious reservations. All right, let's dig in. EVgo's business model is to build, own, and operate EV charging stations, earning money for charging, and also other services like maintaining and operating the stations for other businesses. The goal is by deploying one of the largest networks early in the growth of the electric vehicle market, it can establish operations in high traffic areas, build more brand awareness, and generate regular, high margin recurring revenue. There were about 1.3 million electric vehicles sold in the US in 2024. It's estimated that there will be 9 million EVs driving on US roads by the end of 2025. By 2030, that number is going to grow to a whopping 37 million. And while part of the draw of the EV transition is the ability to plug in at home, it's just going to take a lot of publicly accessible fast chargers to support the refueling needs of this growing market. There will also be significant demand from fleet owners and for businesses that see the opportunity to offer fast charging to their customers and their tenants. EVgo's network had over 950 fast charging stations in 35 states at the end of 2023. It had grown that to over 1,000 by Q3 of 2024. EVgo also has some big corporate partnerships with companies like Pilot Travel Centers and General Motors to build, operate, and maintain charging stations. In total, the company has identified over 30,000 locations for stations that meet its demand and profit criteria. Recently, it also attained some much-needed funding to pay for that growth with $1 billion plus federally guaranteed loan that management plans to use to accelerate its growth. The terms are relatively generous, and the interest rate is likely to prove exceptionally cheap compared to the usual sources of capital that a business at EVgo's stage today would normally have access to. Now, despite the opportunity, EVgo being a successful market-beating investment is not a sure thing. The company continues to burn more cash than it generates, and there's some significant limitations to how it can utilize the federal loan program that won't soften the impact of its operational challenges. We could actually see those operational cash burn challenges accelerate as it builds out stations ahead of the growth in demand. The federal loan, while great, just doesn't erase all of EVgo's capital need problems. Second, some of the assumptions around profitability at scale, well, they're very optimistic. The problem with the EV charging business and making optimistic assumptions is that EVgo will be competing against companies whose charging business exists to make other more important parts of their business better and more profitable. Think about Tesla and even its partner like GM. Their goal is to make sure there's enough stations to accelerate sales of EVs. Pilot isn't necessarily looking to make a ton of money on charging, but just to make sure cars keep stopping at their stations to buy food and snacks. In other words, some of the margin estimates around charging simply may prove to be overly optimistic. Next, there's the per charger metrics that are based on what could prove unrealistic utilization rates. Reality is that the charging station infrastructure has to be overbuilt because demand is not going to be flat. To be successful during peak times, you end up with a lot of chargers that are underutilized most of the time. The capital and operating costs of these underutilized stations make the industry less appealing than some of the estimates that EVgo and its competitors might be counting on. EV charging stations is exactly the kind of frustratingly hard to ignore space that can go bad for investors. Yes, there's going to be tens of thousands of new fast charging stations built over the next decade plus. And what's less clear is how the economics will scale and whether value will flow all the way through to us investors. I'm dubious about that, but the reality is I just can't rule out EVgo possibly beating the market. If I were to put odds on it, I would say the potential is there, but it's still probably less than a 50% likelihood that EVgo does beat the market. All right, let's wrap this up. At The Motley Fool, your comments make us all smarter. Please comment with your research and insights about EVgo and tell us what stock you'd like to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.